Hello, good afternoon, good evening, good morning. Welcome to the latest ISTAT Learning Lab. I have the pleasure here of having Rob Morris with me. Rob doesn't need an intro, but he's a global head of consultancy at Cirium Ascent. So we're going to have a bit of a different take this Learning Lab compared to the usual, where Rob will be doing a presenting a few slides, but then we're going to have a time for him and I to have a small debate about the different topics. So please, if you there's a small button at the bottom of your screen, Q&A, for you to add any questions that you may have that we can also use to discuss, and Rob can answer these questions following each section. So without further ado, Rob, we can start the first section, and we'll have a nice discussion after it.
Thanks, Mamoun. Yes, hello everyone from a very grim, damp, dark-looking Hertfordshire this afternoon. Seems like winter's finally with us. So it's time for Mamoun and I to debate the year ahead. As Mamoun says, a slightly different running order. I'm going to run through. Hopefully, you can see some slides. We're going to run through just a few slides on one of each of 5 sections: current market, trading volumes, lease rates and values, recovery outlook, and sustainability. And after I've presented 3 or 4 slides on each of those themes, I'll stop presenting. Mamoun and I will have a conversation about some of the points I've made, and I'll answer some questions. And of course, if you've got questions, hopefully we'll answer your questions as well. So the current market in 4 slides. From the pandemic, we know that recovery has largely been strong. If I look at capacity and think about where capacity is signaling December is going to be versus December last year, for December 2019, it's indicating we'll be around 13% down. So recovery is strong in domestic markets. Recovery is strong in short, medium, or intra-regional markets. Recovery is increasingly strong in some long-haul markets, with a few exceptions, and I need to make a couple of really important points here. There are clear lags in China and Asia Pacific. It's a somewhat complex chart, but it's effectively traffic lighting where recovery is in each of these markets. And even the China domestic market at the present time is signaling that in December, it will actually be up. It'll be up about 15%, 20%, sorry, over where it were in 2019. But China remains a very challenged market, as I'll show you in the next slide. China's dynamic zero COVID policy is not succeeding and is not allowing recovery in that market to continue. So the schedule in November actually projected around 25% up over November 2019, but it ended the month 15% down. That's the schedule. Cancellations indicated that about half of those scheduled flights didn't take place. So China is increasingly the key to recovery as we debate 2023. And this slide just uses tracking data to demonstrate the same thing. If you look at the right-hand end of this chart, you can see that the domestic market in China has hardly touched 2019 volumes this year at all, other than early in the new year and then just briefly in summer. Remembering back in 2020, we all spoke about China being the potential savior because it had managed to get hold of COVID very quickly and domestic markets recovered. Clearly, that is not the case today. So we need to debate that and how China can recover. Some 15% of all global flights in 2019 touched China. So China is really key to recovery. Just a couple more slides just on the current market. If we think about a really important metric, which is parked aircraft, then we can understand that the return to service, the inverse of this parked aircraft, has been relatively strong, but is perhaps a little bit hidden on the right-hand end here of this chart. Is perhaps slowing a bit as we head into the summer season. But some numbers. So if we think about the start of the pandemic, there were around 1,900 or so parked single-aisle and twin-aisle aircraft, 9% of the total fleet. Today, there's around 2,600 single-aisle, around 1,150 twin-aisle, 15 and 23% respectively. There's around 1,150 surplus single-aisle aircraft remaining parked at present, 700 twin-aisle. Perhaps we can debate where those aircraft are parked, what the outlook for those aircraft is. And then finally, a key a key feature of the recovering part of this cycle is OEM production. OEM production, which recovered from 2019's impact of the MAX, 2020 the pandemic, 2021 deliveries started again. But of course, supply chains have struggled to keep up. Engine supply chains particularly have resulted in significant delays in OEM deliveries. And Airbus, remember, were guiding around 700 deliveries so far in 2022. They delivered around 530 to date. So a significant amount of deliveries still to take place if they are to achieve their expected targets. Boeing, more silent on guidance and much lower numbers. Of course, they're projecting ramp ups to by 2025, 75 A320 a month for Airbus, 14 A220 a month for Airbus, 50 MAX a month for Boeing. We perhaps could debate whether that's realistic, whether that can be achieved. So Mamoun, just in a couple of minutes, that's where we see the current market. I'll stop sharing my slides for now, and
actually, maybe just to keep on this slide, because I
sure.
think this slide is quite relevant for our current market, and you know, as we go to next year. I mean, one of the features of the pandemic was the relatively low supply of aircraft, and very low supply of aircraft. You know, we have to go back, I don't know how many years to go to a similar you know, delivery rate of new aircraft into the market. As you pointed out, supply chain has curtailed the you know, the resurgence of the deliveries. This is purely, just to make sure that it's clear to our audience. This slide only shows the production forecast from the OEMs. This is not a Cirium, or is it a Cirium forecast?
No, so this is so yeah, you're right. The historical bars are actual passenger aircraft deliveries, Airbus and Boeing. For 2022 onwards, it's the deliveries plus the committed backlog in our researchers' estimate. And the line is Ascend by Cirium's forecast concluded in November last year of what we believe would be delivered in a balance in a you know, given the supply and demand dynamic at the time. So the bars are what's committed in backlog, and the reason 2027 goes down is because there are, of course, some open slots in 2027. The reason that Boeing's 2025 number is higher than our forecast is because we still have some hangover of MAX and 787 expected to be delivered then that haven't been delivered in the earlier part where the bars are below the lines. So this is Cirium's view. We don't obviously see the OEM's backlog numbers. This is our researchers' view.
Okay, and the actual, but if you compare with the stated production rates are of the Airbus, as you said, Airbus is you know, is committing to 75 A320 family by 25. First of all, do you think this is how realistic do you expect this to be? If you don't want to answer,
no, I'm happy to answer. I mean, so the numbers on our bars obviously are pretty much fitted to what the OEM statements are. But of course, if you think back to earlier this year, you know, Airbus were talking about 75 in mid 2025, and then in their latest guidance, they've kind of softened that stance and recognised that the ramp up is being hampered by the supply chain challenges, and particularly the engine OEM delivery challenges as they try and effectively double production from, you know, the 30 they were at to 45 up to 75. So we, you know, our opinion is that the 75 could be achieved in 2025. In demand terms, it's justified, but of course we've seen more and more delays, and we're hearing and reading even in the last few days of delays in 2023 deliveries, which suggests the ramp up may be delayed. If I'm honest with you, I didn't have time to include the slide. I mean, Airbus have been talking about being at rate 45 on the A320 for a significant amount of time. But if I measure first flights, I can argue that they've not been at 45 at all this year. So the delays are evident in the data. So yeah, I mean, I think there's a high risk that 75 in 25 may not be achieved.
Thank you. No, that's quite important to note. Yeah.
Shall I stop sharing and we'll just debate, or do you want me to leave the slides on? I don't mind.
Yeah, we can. Yeah, I can turn off the slide. So China is clearly the most important unknown here. I mean, clearly the events on the ground is as we speak, they're nobody knows what's gonna happen in the next few weeks or months. But when we speak to Asian airlines, it is clearly evident that China is a great source of hope for them for the passenger numbers to go up. There's also some worry, that China will have, and Asia in general will suffer from the same type of chaos that Europe and to a certain extent the US experienced over the last 18 months. I mean, how do you think? I mean, obviously the forecasts are very difficult to predict, but what's your estimate on the Chinese reopening?
So first of all, I think recovery in Asia Pacific is obviously paced by China because a significant amount of the capacity in Asia Pacific touches China. Around 1/3 of all international flights in Asia Pacific touch China. So China border reopening is key to Asia Pacic's recovery. In the context of our expectation, and it's very political, so who knows, it's so binary, it's very difficult to predict, but we did expect, like many others, that the Congress in October would be a key milestone, and after the Congress in October, when Xi Jinping was re-elected, he would be emboldened in his policy and he'd be able to think about reopening borders. But of course there's no signs of that yet. I mean, what we're still seeing to some extent, there's been a bit of easing of quarantine policy. So quarantine periods are now shorter for people coming back into China. The lockdowns we saw, which in the early part of the year that produced that sort of flight schedules being 80% down over 2019, those kind of very big strategic lockdowns of cities have become more tactical. The lockdowns are more localized, instead of Shanghai going into lockdown, a precinct goes into lockdown. So there's a small sign of perhaps pace forwards. We think that, and this is just a view, right, but we think that the Chinese New Year becomes really important. The observation of Hong Kong's behavior becomes really important because Hong Kong is now under control, as Xi Jinping put it, and therefore we can see how the virus runs through Hong Kong when we allow Hong Kong to unlock, and then we can decide what we do. New Year, second quarter, potentially maybe where China becomes more accessible. To answer your question about how does Asia Pacific avoid the chaos, and I understand what airlines are thinking. Well, hopefully they can learn from us, because obviously in Europe, we said this time last year, the biggest issue we could have in Europe is not to be prepared. And whilst airlines appeared to have significant numbers of aircraft available, they simply didn't have the people to operate them, or the airports couldn't offer the slots, or they couldn't offer the terminal capacity, or the security capacity, or the baggage handling capacity to manage the aspiring network and schedule, and consequently airlines have had to constrain schedule this year. I could argue though that, as we all know, ticket prices and yields are far higher than they've been for many, many, many years as a consequence of the constrained supply. Most flights that I've been on this year, and I've been on that many, have been very full. So airlines should hopefully be doing better financially in profit terms. Of course, that's absenting the fact that oil price is much higher. But I think airlines in Asia Pacific will hopefully have learned, and their partners, the airports, the network providers, the ATC service providers, they will have been able to provide enough capacity to make sure that next year is not for Asia Pacific what 2022 was for North America and Europe.
So this is on this point of yields and ticket prices. So certainly there's a lot of pent-up demand from people having accumulated quite a bit of savings over the pandemic. They haven't been able to spend it, so they have some extra cash. Those that just need to travel, haven't traveled throughout the pandemic, want to travel. So there's a lot of pent-up demand, as you said. I mean, all planes are full. Ticket, if you've been going to the States anytime recently, or Asia for that matter, it's eye-watering, the ticket prices. So clearly, but the question is, how long will this be sustainable? And maybe slightly different questions in Asia, where there has not been such support from governments directly to the consumers as there has been to a certain extent in Europe, and certainly much more in the US. I mean, do you expect that the pent-up demand will be as strong when China reopens, for example, or is it more a factor of the support from the governments?
Yeah, I think the pent-up demand in Asia Pacific and China, the return of that pent-up demand can be as strong as it were in North America and Europe, because we had the same demand, the levels of demand we saw pre-pandemic could return post-pandemic, absenting some major macroeconomic event, and we'll perhaps get into that in recovery outlook. But of course, in Europe and North America, the signals are a weak or signaling concern potentially for the macroeconomic scenario. But certainly when I was in Singapore for an event back in early November, there was a lot of optimism that the macroeconomics that were coming at us in North America and Europe would not be emerging in Asia Pacific and China. Now, obviously, China has to think about its lockdown policy and how that's impacting the economy right now. Production, which was largely servicing other economies, needs to return, and GDP growth, which has been significantly lower than target, needs to recover. And that's something that the Chinese leadership will no doubt be considering when it thinks about its policies. But I think Asia Pacific has the optimism that they will not be hit by the same potential economic woes. So the unlock of demand can be as strong as it were in our developed regions in North America and Europe, but actually we won't be then hitting the same perhaps roadblocks that we're now facing as we head into 2023 in Europe and North America. Optimism.
Great. Shall we move on to next?
Yeah,
topic?
sure. So I'll share the next set of slides, which hopefully I can find there. Let me try that. Hopefully people are now seeing my slides again.
I'm seeing your slides, but not in full screen.
Are you seeing them in full screen now?
Not yet.
I see the blue circle, so it might just be loading there.
Let me try one more thing. Let me just try one more thing. Got it this time, I think.
Yeah, you did. Great.
Yep. I know what I've got to do. Okay, so trading volumes next. So Mamoun, just in 3 or 4 slides, thinking about trading volumes. So I just want to make a point before I get into actual trading volumes in 3 slides that demonstrate what our Cirium data says is happening. I want to look at just availability. This is thinking about leasing availability now, particularly used aircraft. So through the early part of the pandemic, the availability of used aircraft fundamentally increased as lessors were unable to place aircraft that were either coming back unscheduled or scheduled. But once we got into 2021 and lessors understood how the demand scenario was playing out and understood what the pricing required to clear aircraft was, that the leasing availability effectively plateaued, and it ticked up a bit for Russia in early 22, but it's declined ever since. It's still higher than it were in 2020, and I think that's about some of that parked inventory still waiting to go to part out, because there's many more older aircraft in this inventory than there was. But there's been some positive signals in the context of aircraft being placed. And that's evident in the next slide, which demonstrates the volume of new leases for used aircraft, which has recovered to pre-pandemic volumes. If you just look at the solid line, which is a 12-month rolling average of the dotted line, which is monthly new leases for used aircraft recorded in Cirium's fleets data, you can see that for single aisle, we're as high as we were in the last part of the pre-pandemic cycle, which was very strong for demand. The more important one, I think, or more interesting one, is the red line. There have been more used leases for twin aisle aircraft in the last few months than there were at any point in the last cycle. That's an interesting point in the context of stored fleets of twin aisle aircraft, and perhaps some of the aircraft that are more available for immediate placement getting out there now. If we think about trading in a slightly different way, purchase and leasebacks, volumes have remained strong because, of course, that's the way that airlines have been raising capital through the pandemic, but they've not been as strong as they were at previous points of the last cycle. And sale and leaseback volumes for twin aisle aircraft, by contrast to the last chart, which showed lots of used leases, have been very low. The preference is pretty clear for single aisle. The final slide, just in this short section, looks at the volume of aircraft trading with leases attached, which recovered for single aisles a bit in early 22, but actually has been relatively much lower than it were at any point in the last cycle, whilst the trading of aircraft, of twin aisle aircraft with leases attached, is really low, virtually zero. So for now, it seems that lessors are able to place aircraft on lease. They're able to transact sale and leasebacks, but they're not able to trade aircraft amongst themselves at the same level that they were in 2019 and before.
Is this the last slide on this?
Yeah, that's
one?
the last slide. I'll talk about lease rates and values in the next section. So maybe
No, but again, very interesting metrics there. I mean, from a lessor perspective, I mean, I absolutely concur with the trading volumes have been much lower than in the past. Previous cycle. Now, what I think to bear in mind on the sale and leaseback, and especially on the wide body side, but also to a certain extent on the narrow body side, just the production rates have been lower. Sale and leaseback are done mostly on newly delivered units, and therefore, with the production rate, it's normal that sale and leaseback volumes are lower than previous cycle.
Yeah, I agree, but I've got a small data fact point to kind of just counter that slightly. So if we look at the number of aircraft, the percentage of aircraft that have been transacted for sale leaseback of new deliveries, this year it's about 3 or 4 percentage points lower than it were last year. So we are seeing fewer of the aircraft that are being delivered from the manufacturer's production lines so far being transacted for sale and leaseback. It's about 23 percentage points or so compared to 27% last year. So there is a slightly lower volume. You're right. There are fewer subject aircraft, if you like, and I think the competitive environment is still as strong as it were. There are as many players chasing those aircraft, and that's having some impact on pricing. There's one other point to make in 2020. So you're right. Typically, in any one year, the percentage of aircraft that have been acquired through sale leaseback will be about 75% new deliveries, 25% used aircraft, but typically younger used aircraft. In 2020, that flipped. In 2020, about 75% of the sale leasebacks, because the volume, as you saw, was very similar, but about 3/4 were new aircraft return to the 75-25 mix. So there are fewer used aircraft, if you like, which are available for transacting, but the volumes are slightly lower. You're right, the absolute volumes are lower because lower production rate.
And also now, looking a bit forward, the fact that we're moving into a very different financing environment, clearly, with the higher interest rates. Are you able to factor in some of those factors into how do you see the trading volumes on the three metrics that you have shown here? Do you have any forecast, or is it difficult to?
So not really forecast, but I mean, one of the reasons that I suspect that we're seeing fewer aircraft trading with leases attached right now is because it's that willing buyer, willing seller dynamic. So at the moment, even over the past 6-9 months, we've heard lots of anecdote of portfolios or small sub portfolios of aircraft being offered for sale. But we haven't necessarily seen those deals closing yet because the seller's aspiration and the buyer's aspirations are not matched right now. And I think if I think about that, I suspect to some extent there's going to be, we're carrying these assets on our books at a certain price or certain book value. And if we want to sell that asset to realize, release our capital and move on to another investment, then we need to be able to achieve at least that book. And if I think about where values have gone through the pandemic, perhaps the buyer's aspiration doesn't necessarily meet that book value requirement yet. So, there's going to be that conundrum of, have we taken sufficient impairment, if impairment is required to be able to release that asset for sale and achieve the required asset value that allows that sale. I think, moving forward, as values recover, we might see that issue repaired somewhat. So that might mean there's a higher volume. I think the other reason is going to be the point that I exchanged with you this morning. I was, and maybe we'll talk about it a bit later, but I'll raise it now. Air Lease reported as raising 700 million unsecured next month at 5.85% coupon, compared to raising similar capital at 2.2 just 10, 11 months ago. That's illustrative of the cost of debt that the industry is going to be having to carry, perhaps moving forward. And if you're having to carry that debt to refinance your assets, perhaps you might find it more financially tractable or attractive to release those assets through a sale than having to carry much higher costs of debt to refinance. So I think there's going to be a lot of consideration around that moving forward. And we've been arguing for the last couple of years that lessors' cost of debt is more efficient than airlines' cost of debt. I'm not saying airlines aren't going to be paying higher than 5.85. They probably are, but moving into 2023, the financing environment is going to cause some very different, I think, decisions to be taken to those that we've seen through the last couple of years or pre-pandemic.
I fully agree with that, and so we have seen a lot of what you mentioned before in our everyday trading activity, as far as people not able to close on deals because the financing environment have moved, people walking away, and also simply the fact that the ask and bid price are simply too wide apart for deals to be consumed, and therefore that's that reason the trading volumes are this low. And next year will be very interesting, because on one side, as your previous graph showed, supply of aircraft is increasing, but at the same time, the potential demand, in view of the higher financing cost, may decrease, and therefore we could be in a very different market than we were, in the past few months.
Actually, it's a really good point you make there, Mamoun, as well, because as financing costs increase, the delta financing cost between new and used aircraft with different values, different capital costs, also changes. The dynamic between the desire for new and used aircraft, which is to be being driven to some extent by sustainability, as we'll discuss later, because people are looking for increasingly lower, better fuel burn. But actually, there's a capital cost consideration in that argument as well. And actually, another argument I've heard quite frequently recently, which is one of the reasons I think driving those used leases to be so attractive. First of all, I spoke about OEM delays, but of course, if airlines are struggling to get new aircraft from OEMs because of those delays, then their natural safe shelter is to go to a used aircraft, because they know that's available, and that's driven some of that. The other point about that, those used trading volumes, is that a lot of those leases have been into Europe. More than half of the leases in the last 18 months have been into Europe. Europe is not half the market, but Europe's recovered strongly. So as Asia Pacific comes back, I read it the other day, AirAsia X, an airline that has had some significant challenges in the last few years and cancelled lots of new OEM orders, is now saying it's in the market for used A330s potentially, because it sees 2023 as positive. So whilst one market is stabilizing, the next market returns, and that could create some positive demand features for next year.
Right. Well, since we're touching upon A330s and values, maybe we'll move to the next topic.
Sure. Let's see if I can make this happen again. I think we'll have to do what I did before, which is share it, go to main screen. Let's see. Right. I presume you're not seeing that yet.
Not yet.
No. So I'll stop and start again on share. That's it, the main screen. Got it. Hopefully you're seeing
Perfect.
that now.
Yes, we are. Thanks.
By the time we finish, Mamoun, I'll have worked it out. So lease rates and value. I've just got three slides here, which effectively are designed to help us understand how first values, then lease rates, and then sentiment has changed through the pandemic. So this first slide, a little complex, but hopefully relatively simply explained, shows how Ascend by Cirium's value opinion for this basket of aircraft have changed over the pandemic. Effectively, the open circles are fleet weighted average market value changes from January 2020 to July 2021. So, for example, you can see there that we have a 30% reduction on 737-800 values between January 2020 and July 21, and then the closed circles are the same changes to September 2022. So, in other words, where the circle, the closed circle sits above the open circle, we've seen market value improvement since 2021. And you can see that for single aisle, certainly, there's been improvement. Now, for wide body, the improvements come, but a bit later. So I didn't have a slide that showed the numbers, but we've made changes in September and November, which are positive. So 777-300ER, for example, and an asset you'll know a lot about, obviously, where we had a 50% reduction in market values between January 2020 and July 21 and September 22, the circle's sitting on the same dot there. We've seen a 30% improvement in our market value opinion since then. So we're effectively 20% down over where we were at the start of 2020, given that's a depreciating population of aircraft, then the real market value changes are slightly less than that, slightly better than that effectively. So we've seen 879 improvements, we've seen A350 improvements, in fact A350 above where it were in 2020 now. We've seen less action actually on 330, and perhaps we can discuss 330 particularly, but 330 still, despite the fact we've seen lots of asset placements, still showing some negative value changes this year over last, but very minor. Lease rates reacting a bit more positively, a bit more stability, not quite such significant changes downwards, and again the same kind of changes upwards that we've seen for the wide bodies I talked about earlier, the 879-350 and 777-300ER in the last couple of months that aren't on this slide. So, you know, I think to summarize it really quickly, and by the way, 737 and A320 are in active research now. We always freeze values at the start of December, but before we freeze our values for the year end to inflate in January, we will be revisiting those aircraft at the values review board, and I suspect we'll see some positive changes there. So that's how the market values and lease rates have changed. What about sentiment? So something we've been doing since early 21 at Ascend is running a market sentiment index survey on a monthly basis, just to understand the market's view on values and lease rates. And this is just a net promoter score index. So I've taken the axis off because it doesn't mean anything in number terms, but it's the trend that's important. You can see how the market itself sees a strong and positive sentiment for both values and lease rates. This is Ascend by Cirium's values compared to the market. So in other words, people are telling us our values are probably should be going up, and the trend, we're seeing trend to positivity. In fact, it's a great survey. You can see we ran lease rates in April 22, and you can see there was a slight downturn in sentiment there, completely linked to the Russia-Ukraine conflict, where you remember in March and April we were uncertain about what would happen with lease rates, but of course we know now that story, and we can see the positive trend that's recovered there. So you know, a strong impact on values and lease rates of the pandemic, continued recovery through 21 and 22, and positive sentiment, Mamoun, is how I would classify or summarize that section.
No, indeed. Thank you for that. Just to go back on the that's pretty staggering. The variation of some of the assets, including 777s, as you say, an asset that I hold dear. How would you explain such a wide variation? Is it simply a factor of supply and demand, or I mean, is it just, you know, the cargo aspect of it? What's a
mix of all? So I think you know, supply and demand is the key driver to values and lease rates in the macro sense. So thinking about the 777-300ER, you've got the kind of macro supply and demand point. So first of all, think about supply. So as long haul markets start to recover, and even through the pandemic, when the 777-300ER was a very effective freighter, if there was no passenger network, you had no supply forces putting pressure on the 777-300ER. The 777-9, as we know, is delayed until 2024 or 5. I think it's 2025. So I read just this morning, Singapore, I think, talking about the fact that they'll retain 777-300ERs in service longer than expected to mitigate for the delay in 777-9. So there's lack of supply forces. And meanwhile, the demand forces are largely positive. So as well as the macro demand, there's that return of long haul networks. The 747 is pretty much gone. The A380 is returning, but it's returning in some niche markets only, and it doesn't have great freight capacity. The 777-300ER still does, even as a passenger aircraft. So positive forces there, delays. And finally, actually, one of the reasons we've seen values increase so much is because the engine values have recovered strongly. The G90 115 value is recovering as people see demand for engines, because shop visits are A, expensive, B, hard to find a slot. So whilst there's been some limited part out activity on the 777-300ER in 2020 and 2021, there's been none this year because there's probably enough engines in the market now. But that demand for engines brought engine values up, which brought the aircraft values back up as well.
Appreciate that. One of the attendees has asking about regional jets, E-jets, and I mean, how do these? I mean, you don't have a slide for them, but how do these values and these rates have recovered? Are they on a similar trend, or?
Yeah, so I don't have the numbers in my head immediately, but I think we've seen relative stability there, because again, the supply forces there. First of all, that the regional market recovered relatively quickly compared to single aisle and twin aisle markets, because they were largely domestic markets and intra-regional markets, and also people using the smaller aircraft to protect specific routes, specific slots, etc. But that slowed because now we know about one of the drivers to the infrastructure challenge this year in North America has been pilot shortage. So when you've got a shortage of pilots, you don't want to be having them flying the smaller aircraft. So that's kind of slowed, and the regional market has stabilized. Meanwhile, you've a very changed competitive dynamic with one OEM, Embraer, because Bombardier and Mitsubishi have exited the market. So you've got a kind of monopoly at relatively low new production. Finally, also the E2 has really struggled to establish itself in the market beyond the 195. So the smaller E2s, the 175 isn't even certificated yet. The 190 E2's got a very small market. So I think we've seen relatively less supply pressure there, but also demand not being particularly strong. So we've seen value stability, I think, in that market right now. I haven't got the lease rate numbers in my head, so Mamoun, it'd be wrong of me to comment further on that.
That's fine. On we talked about the wide bodies and regional. So on the narrow body side, clearly the recovery, as you said, there's been quite a bit in Europe and North America. Do we need the rest of the regions to really come back to see further improvement in lease rates and market values?
Yeah, I think we do, but I think they will. I mean, I think the OEM supply challenge I've spoken about already is causing some issue there, because obviously with slower than expected deliveries, there is that, again, that supply pressure is not existing. We're not pushing from above, which creates pressure. Meanwhile, demand is still strong, or has been strong this summer in Europe and North America, and in some recovering Asian markets. We've seen markets like Indonesia absorbing used A320s. We've seen markets like India interested in used A320s, Australia, etc. So even China continues to take delivery of new A320, albeit a number of those aircraft don't appear to be getting into service yet because of the domestic challenge in that market. But I think in 23 we probably still need to see continued recovery in those markets, because the point I didn't make earlier, but a lot of that supply that went into Europe in 2022 has gone into ACMI carriers, and that's marginal capacity. And if, and it's a big if, and we'll talk about it in the next section, we do see some potential weakness in Europe in 2023, then that marginal capacity needs to find somewhere else to go where it's not going to be earning revenue, because it's probably on a PBH type deal. So I think we do need the other regions, particularly Asia Pacific, to continue its recovery, which has been slower paced this year, into 23, if the market is going to remain strong, and if lease rates are going to continue to have that positive trend in outlook.
Thanks. Before we go, and I'm not sure if this topic or next one, but we haven't talked about inflation that much. How will inflation affect asset values and lease rates?
It's a really great question. Let's do it now, because I haven't really got much in the next section on inflation particularly. So if we refer back to all of our historical data that exists in the prior high inflationary environment, i.e. the 1980s, we can see that inflation did drive asset values to appreciate in nominal terms significantly. There are, it's anecdote, but our data also shows that there are aircraft delivered in the early 1980s whose current market values were higher than the current market value at delivery 6, 7, 8 years later because of the structurally high inflation. So what does that mean for today? Well, I suppose it means that we do expect aircraft values to see positive pressure from inflation. But I think I answer the question with a question. I mean, are we in a structurally higher inflationary environment today than we have been, or than we have seen over the past 15 or so years? And I think it's hard for us to set our minds back to a few years ago and say we're not in that structurally higher inflationary environment, because today inflation is close to double digit, albeit in North America, of course, inflation is now calming a wee bit. Where is inflation going to be next year? If one thinks about the drivers to inflation, high energy prices, right? High energy prices, well, energy prices have been volatile in the last month or two. I mean, fuel prices have gone up and down. Oil prices have gone up and down. Crude oil, Brent crude, when I last checked, is below 80 a barrel, compared to 110 plus where it were 2 months ago or so. So once we get through to next June, July, August, and we start to see if oil prices are where they still are today, then inflationary pressures from that have gone. We're not seeing increases. So inflation could start to temper downwards as we get into the second half of next year. So, that's the first point. The second point actually is asset value inflation must be driven by price inflation, and price inflation must be driven by escalation, a different argument. So I haven't got the chart in my deck here today, but I've been using a chart in presentations recently that shows our estimation of OEM escalation formulae over the past long term, but actually over the past 12 months, where it's gone structurally from a few percent to close to 10%, 7 to 8 to 9%. Now, we're saying that's just the outcome of the calculation. We're not saying that means that prices for new aircraft will go up by that, because of course each contract's going to have a different escalation clause, and each escalation clause probably depends upon the long-term escalation. So there'll be, if you've ordered 6, 7 years ago, you're going to have 5 years of lower escalation plus maybe a year or two at the back end of higher. So your average is going to be low. But as we see more and more orders in this environment, we might see manufacturer delivered prices going up. So as new aircraft prices go up, so perhaps our value opinion should go up if those aircraft could trade in the secondary market for those prices or values. And if used aircraft values come up, then in my sort of DOC pie, the potential you could realize for used aircraft should also come up, because you've got a whole equation. So one might expect that inflation will drive values up. Of course, for current market, we have to observe that based upon what we see assets trading for. That's how we calibrate current market value. For base values, we've been going through at Ascend a huge debate at our value review board in the last few months about what we're going to do about inflation. Typically, we inflate base values on the 1st of January every year, and we used to use CPI in November as our driver to that. We would mechanistically apply CPI because it was low. We didn't mechanistically apply CPI last year because it was 5%. I think we applied 3 from memory, and then we applied a bit more in summer. This year it's going to be 7 or 8 when we come to see the number in November for January. We won't be inflating by that, but we'll be inflating by a higher number that I think we have historically. So George Dimitrov, our head of valuations, wrote a white paper recently, published it. It is available. It talks about our approach to inflation, but we haven't made a decision yet on the actual number. The final point is, when you think about what you consume from an appraiser, You know, most of our online platforms, whether it be ours or others, I don't know others, but ours certainly, you get a constant uninflated outcome on the future base value, and then you can apply a number based upon a range we allow. We've typically allowed 0 to 3%. I think we'll typically continue to allow 0 to 3% for now, because obviously to allow 5 or 6% compounded over 20 years would be high risk in the context of future value. So I think, yeah, a long way of saying positive pressure. But I think,
but I think I agree on the second term. I really think that, you know, the OEM manufacturing increase cost will definitely should drive up, you know, values. We're going to see airlines will want to recoup that on sale and leasebacks, and it probably will even need to go to leasing more often.
Yeah,
because of this increase.
Yeah, but of course the point there is, sorry to interrupt you before you ask a question, but lessors will also be paying those escalated prices. Absolutely. And of course, in the context of lease rates, you know, lessors have been pretty vocal. With high interest rates and increasing prices, we expect to be able to realize higher rents for new aircraft. And of course, they all say we have mechanisms built into our contracts to allow that to happen. Well, that's fine for new aircraft. If you've placed an aircraft from your order book 2, 3, 4 years hence, you'll have put a contract clause in that says we agree a base rent, we agree an escalation formula based upon interest rates or swap rates, and when we deliver in 4 years' time, Mr. Airline, you will agree to pay base rate times X, and everyone knows about that. Whether, of course, most the contract then doesn't have a floating lease rate agreement thereafter. The airline agrees to pay the rent for the next period of term of the lease. There are very few floating lease rate contracts in the market, in our understanding, and thus can that increasing rent for new aircraft feed back through to increasing rent for used aircraft? Same argument as for values. Potentially, in a completely closed environment, it should. But of course, the market today for leasing is much more competitive than the market were the last time we had high interest rates and high inflation. There are, and I'll talk about single aisles and other numbers, there are more than 100 operating lessors offering single aisle aircraft in the market today, each with different costs of capital, each with different costs of debt, each with different return requirements, each with different motivations when they place their aircraft. That might mean that supply and demand dynamic trumps the logical desire to get higher rents because interest rates have gone up. It might mean, I don't know, we have to observe, but I think supply and demand dynamic is a key driver to rents in 2023 still.
There's, I think, one more factor that we didn't mention is the actual cost of engine maintenance. I mean, that when you talk to some engine OEMs, you know, you're talking about 10, 11, 12% inflation on parts, etc. So, I mean, how that also should feed into, the value that they have still more green life will be more valuable than before because of this.
That does feed in, Mamoun, and in our discussions in our value review board in the last few weeks, we have recognised the engine manufacturer escalation in their catalogue pricing and also in their maintenance costs. And we have recognised that we need to have a premium above our standard inflation assumption for the maintenance add-on. So if you look at, we've examples now in our system where if you look at the half-life to full life, going out 10, 15 years, you might see a half-life declining, but a full life increasing because of the maintenance add-on. Now, whether for an asset that is a certain age and beyond, you can realise in the market the maintenance premium, or whether the maintenance premium becomes a differentiator in the terms of placement. The airline prefers to take the aircraft that has more maintenance utility remaining, but won't pay I don't know. You would know that better than I. I've seen some of that when I was trading aircraft in my previous role, asset management many years ago. But for sure, we've recognised that maintenance costs will increase above inflation, and we've recognised therefore the half-life to full life add-on will become more valuable in the future.
Great. Shall we move to the next one?
Yeah, sure. Let me share the screen in the same way again. So I'll share that. Press presentation. Right. stop share and then share screen, and hopefully you're seeing the recovery outlook slides. So I've already to some extent alluded to 2023 and clouds on the horizon, and the slides I've got are just again 4 slides that first of all look at a couple of indicators and then look at our recovery scenario. And one of the key things we understand about our industry is that economic growth drives demand growth, or drives demand, if you like. And if we think about the Economist Intelligence Unit GDP forecast that we consume at Ascend as we build our base value curves, or we build our demand forecasts, they've fundamentally softened as we head through 2022, both for 2022 economic growth as it arrives and 2023 outlook. So back in this time last year, the EIU was telling us that world GDP would grow at 4% this year, and that in Europe we would see growth of around that quantum. But as we headed into 2022 and saw the impacts of the conflict on supply chain and the energy costs and inflation and all of that, food costs, etc., the GDP growth that we are being supplied with have fundamentally weakened. That the expectations would be below 3% globally this year, and in Europe below 3%. In North America, just over 2%, and then just on the right hand end, the dots for 2023 are signalling even slower growth. So global GDP growth that was forecast for 2023 in January this year to be 3%. Is predicted to come in at close to 2%. So, slowing economic activity. And then I've just chosen one of a number of metrics we use to explain economic outlook, and I've chosen PMIs because the Purchasing Manager Indices they're a sentiment index, but they're a forward-looking index. I mean, very volatile, obviously through the pandemic. Significant optimism in the US, in the Eurozone composite through 2021, but increasingly, and 50, by the way, 50, if it's below 50, it indicates, expectation of economic contraction or recession. And we're seeing in Europe, in US, even in China, manufacturing PMI, an expectation of global recession. Europe almost certainly going to see a recession in 2023. It's hard when we're sitting in the UK to comment too much on that because our outlook is even worse. Some signs of improvement in the US, but actually a tough 2023 from a macroeconomic perspective. What does that mean in the context of our recovery scenario and expectation? Well, it's been tough to model any traffic growth, if you like, through the pandemic, because we know that, we talked about it earlier, the release of demand, the pent-up demand effectively allowed growth well above where we would expect it to be given traditional economic behaviors. But we modeled some scenarios which are effectively estimations or guesses. Now they're regional based, so we have a regional expectation of recovery here that sums up to this overall expectation of recovery. And I've just put the last 2 scenarios, 6, which was concluded in September 2021, and 7, which was concluded a revision in early August of this year. And the dark blue line, illustrates the actual IATA traffic numbers compared to the bars, which are the volume of traffic we expected in each month as a consequence of the regional sum up. And that the only real point I need to make here is that we see downside risk. If you look at the traffic reported in August and September, which is the last 2 months that IATA reported traffic numbers for, compared to our projection made in effectively late July, we are already seeing divergence on the downside, which suggests that our expectation of recovery to 2019 volumes globally in the 4th quarter of 2023 is perhaps a little optimistic. Now, I was debating this with one of my team earlier this week, and his suggestion was that we're hoping for better numbers in October and maybe through the 4th quarter, but we will see. We can talk about what the macroeconomic that I talked about before would do for this in questions in a minute. One final point, though, I just want to talk about the fleet and again surplus aircraft, because when I take the scenario, the recovery scenario, and model through some productivity and some fleet, some retirements, I can convince myself that by 2024, the number of twin aisles that are parked would be around 8% of the overall fleet. Remember, at the start, I said that it was 9% at the start of the pandemic. So 9% was kind of the balanced supply and demand dynamic. So that says to me, there will not be enough twin aisles by 2024, given what we think about OEM production, retirements, and the recovery scenario. By contrast, the single aisle will be around 9.5%. So the fleet's grown by then. So pretty much in balance. But I think we might see for a short period of time not enough twin aisle aircraft in the market. Yeah, that's the end of that section. Mamoun, over to you for questions.
Yeah, thanks for a lot. Certainly I mean, at Novus, we certainly do think that there will be a undercapacity as far as the wide bodies in the coming few years, in view of the fact of the low production rates and the rebound in demand. Now, I mean, not to belabor this point too much. I mean, will that how can we transform that into actual numbers as far as this will really be market value improvement, or what I mean, because really this will be just extended life of the current aircraft, right?
Yeah, I mean theoretically there should, if there is going to be an imbalance of supply and demand for twin aisle aircraft where there is insufficient supply for the expected demand, then of course we would expect positive pressure on values and lease rates. There are many variables though that could put that kind of statement at risk. So the first variable itself is the macroeconomic outlook and what that means for the supply and demand dynamic. Because if there is downside risk in the recovery scenario, or if China borders are slower to reopen, they don't come back in the second quarter next year, and China fundamentally drags the whole recovery hypothesis into 2024, then that could mean demand for twin aisle aircraft is slightly slower. And of course, you know, in 2025 or 6, when the 777-9 finally appears and A350 rates are being ramped up by Airbus, who competitively respond to that aircraft, then we might see that balance of supply and demand turn, you know, against used aircraft. So the recovery of those long haul networks is a key, and the macroeconomics that drive that recovery are a key, and they're kind of unknowns right now. But yes, in the macro, if our hypothesis that I've just shown is correct, there should be increasingly positive pressure on values and lease rates still.
And on the previous slide, you know, scenario 7, you clearly mentioned that it doesn't, you know, include, you know, negative, you know, economic sentiment that is everybody's expecting. I mean, have you done any sensitivity on how bad it will, if the recession is if it's shallow and long, as some people are predicting, what kind of effect it will do on our PK? But if it is, you know, deeper and, you know, and shorter, how will that affect RPKs?
So we haven't really done a sensitivity analysis, because the model is just it's an estimation. Effectively, it's a group of us sitting down, and one of my team, actually, really Richard Evans, I must call him out because Richard's done all the hard work on just where we think in each region traffic will be relative to 2019 in each month of the period to 2024. This model runs the end of 2024. We know that if you look at the divergence in August, it was about 0.8% below our hypothesis, but there was divergence in every single region. If you look at September, it's about 2 percentage points down. There is divergence in most regions, but the greatest divergence on the downside is China. So it's China that will drag the model down, if you like, and we probably need to think about, if it carries on, we'll sit down probably in February or March next year and remodel scenario 8 by then. The biggest unknown, though, and Rich and I were discussing this earlier, actually, because he was doing something else for a webinar we're doing tomorrow. We've just put a slide together that looks at kind of, if you like, worries, things that could derail the hypothesis, like, you know, the war goes on for longer than we expect, the macroeconomic impact in the recession in Europe is deeper than we expect. Airline performance, I mean, we haven't talked about airline performance really very much here, but I worry a lot. That's why I've got grey hair. But actually, if I listen to airlines, they tell me not to worry. I mean, all of the airlines' earnings statements I hear right now are saying, "Oh, forward bookings look good for next year." I hear people say bookings are on a much shorter horizon, you know, where people might have been booking through to July, August, September next year, they're booking through March, April, but the forward bookings we have are positive. Actually, one that was most interesting was EasyJet, not this last quarter, but the quarter before. They said something like, I can't remember the exact words, but it was something like, our load factor bookings now are better than they were at the same point in 2019. I took that to be a tiny bit of spin. I took that to mean we have sold more of the capacity we have offered now than we did in 2019. Of course, in 2019, we offered far more capacity. So we've probably sold less seats, but we've sold more of the seats we have. And I think that's quite positive, because that's about thinking about, let's just control the capacity a bit still. Let's not get into that market share chase we've always been involved in. And let's try and manage price and profit. So I think airlines are telling us not to worry. I think the macroeconomics tell us to worry. It's hard to read them both, Mamoun, right now. So it's hard to know what the impact is on the, and all we can do is measure the data each month and report it.
I mean, this is for me the biggest mystery that we have until now. That despite all the negative news and inflation and the recession and all what have you, airlines seem to be very, very confident, and the yields. I mean, certainly it was. I'm not seeing any relaxation on the yields. They're still very high ticket prices. I wish would love to talk more about airline performance, because obviously it's such an important part of this. But we're bearing time in mind. I suggest we move on to the next topic.
Sure. The next topic is sustainability. So let me do the same thing. Presumably you're not seeing that, so I stop share again. Oh no, I didn't do that right. Let me just share screen.
You did it right, I think.
Did I that time?
Yeah.
Can you see? Are you seeing it?
I don't see it full screen now.
Let me just stop share, and then I think it'll work this time. There we go. So hopefully you're seeing the slides full screen.
Yeah, perfect. Yeah.
Yeah, perfect. So sustainability, just 4 slides again, and I think there's a couple of really, really important points to make here and to discuss. So I've not shared the pathway to net zero that we often present, but it's not our pathway, it's ATAG or IATA. But I often hear people in our industry talk about the most important mitigant is technology. Investing in new, more fuel-efficient aircraft is a key way of getting to net zero. Yes, it's helpful, but we need to do a lot more than just acquire aircraft that burn less fuel to get to net zero by 2050. Because in our predictions, in our projections, we have capacity, which, by the way, if I go back to 15, 20 years ago, we'd have projected we'll grow at 5% per annum over the next 20 years. We have it growing at 3.9% compound annual, but emissions growing at 3.1. So technology is giving you about 10% of the mitigant to net zero. We need to do more for the other 90%. A really important point about the way we can mitigate emissions is to look at how we measure them and to think about where they're emitted from. And long-haul twin aisles made up 50% of all CO2 emissions from our industry in 2019. They're the hardest to replace by new, novel technology, electric or hydrogen. It's just, it is going to be physically, because of physics, impossible, I think, to mitigate those long-haul emissions fundamentally by 2050. This chart demonstrates, of course, and this is a really risky chart that needs voicing very carefully. This chart demonstrates that the best way to mitigate emissions is to not fly, because, of course, emissions in 2020 were half of those in 2019. But, of course, we know demand was 2/3 of what it were. So we need to be really cautious when we talk about how hard it is to get to net zero, because this chart shows a pathway that is not palatable to us. So the key mitigant clearly is going to be sustainable, or one of the key mitigants is going to be sustainable fuel. And if I think about sustainable fuel or offsets, because offsets is the other mitigant, offsets is a very imperfect science, I would argue, which is very, very difficult to understand. SAF is a better understood mitigant, but our sister company at RELX, ICIS, the Independent Commodities Information Service, has a projection of SAF demand, which is effectively based on SAF supply. And their expectation in their latest forecast, published just a couple of months ago, is that by 2030, SAF usage globally will be around 4% of all fuel usage from commercial flights. Only 4%. and by 2050, only about 20%, which is far below what IATA estimate it needs to be at 65%. Now that's a supply-driven forecast. So what that is simply saying is we cannot achieve the amount we need to because the supply doesn't exist today. Yeah, that's the final slide in this section, Mamoun. I've got a summary slide, but I won't use it because we're running out of time, and we can just share that with the participants afterwards. But let's get into talking about sustainability.
Yeah, I mean, clearly one of the most important, if not the most important topic for our industry in this day and age. And you know, I've been saying this for some time that, you know, wide bodies is, you know, physically you cannot, whatever technology you can create, hydrogen, hybrid, electrical, it doesn't work for long haul. It's great for, you know, eVTOL, air taxis, but this is not what we need to achieve the net zero. Clearly, we need to find a solution for the long haul, which represent the majority of the emissions. And SAF is the only way, and there really needs, and this is where technology can help, because I do think that with the right investment, with the right partners, that, you know, we will be able to create a sustainable and scalable, you know, SAF supply that will, you know, because right now it's not the same level, it's not a level playing field between SAF and jet fuel, right? I mean, it's jet fuel is still quite a bit cheaper, especially when oil price goes below $80. So really we need technology to have the enough supply to bring it to a scalable way that it becomes cheaper now. How cheap is the question, and there's a role that governments need to play as well, I think.
Yeah, I think another point is that we simply probably have to recognise that if SAF is going to be a key mitigant, it is inevitable that the cost of that fuel will increase. Well, the cost of our fuel will increase. I mean, it's hard to get a handle on absolutely the delta cost between jet kerosene and SAF, but, you know, one often hears 2 to 3 times. So if I look at IATA's numbers, last year IATA reported that fuel was around 24% of airline expense generally. So if we were to go to all SAF, then 24% goes up 2 to 3 times. We've got a significant amount of increased cost in our industry now. As price goes, I mean, if that's passed through to the consumer, as it inevitably will be, then as price goes up, in real terms, demand goes down. So, you know, I alluded to it a bit on my first slide in this section. We already have lower growth expectation in the forecast, in the 20-year forecast we're producing today, than we would have had 10, 15 years ago. And think about the last cycle, by the way. In the last cycle, bearing in mind that, you know, when I started in 1990, everyone told me, and I learned this, that it's hammered into me, this is a 5% per annum long-term growth industry. But actually, in the last cycle, we grew at 6%. That's because cost was coming down, because low cost, we were seeing traffic transfer from network carriers to low-cost carriers who had a really good understanding of how to deliver much lower cost travel and a great understanding of the gearing between demand and supply and price. So they could use price adjustment to leverage up demand and therefore grow the cycle at 6% rather than 5%. So having come from that much longer growth cycle with much higher growth, we probably need to get into our heads now that we expect to see lower growth going forward. The growth will start with a 3 in over 20 years rather than 4 or 5. So that isn't an issue. It isn't an issue. We're still robust. We've still got high volume. We've still got large replacement demand. We've still got significant opportunities, but we may not see the growth we would expect to see in the future. We would expect to see in the past. But that's the first message. The other message is SAF itself. We need to be conscious that, you know, my chart that shows the best way to mitigate is to not fly. That's a bad chart. Absolutely. We need to message that properly, because if we hear people saying SAF is not possible, the cost is not sustainable, then we're effectively saying we don't believe, or we're effectively saying the roadmap to net zero is high risk. We may not be able to achieve it. And the more we diverge from that roadmap to net zero over the next few years, the more we feed the environmentalists who, or even the governments who may wish to regulate against us to stop us flying, to reduce emissions that way. So we have to find ways of messaging this positively, because it's a really critical message that we need to be able to see even that growth at 3% plus.
And we have seen that message clearly by you know, is in Scandinavia with the flight shame. I'm not going to try and say it in Swedish.
Yeah, exactly.
but yes, it's clearly there is, we need to communicate that you know, there's other ways of getting to net zero in a meaningful way, not greenwashing and not just simply marketing.
Yeah, of course.
So I think we do that through SAF is hopefully one, but the carbon capture is another, as you mentioned. I mean, there's, I think there's, and their technology has a huge role to play in improving the carbon capture side of things.
I think plus also the messaging about how important the commercial aviation sector is to the global economy. The fact that we are the enabler of globalization, and we are the enabler of economic growth. So whilst economic growth drives demand to grow, demand drives economic growth. It's a circular argument. So making that argument, which people have done very well, but they must also remember to marry the two together. We're a very critical sector for the global economy. We're a sector that is really hard to decarbonize unless we find technologies that are credible, scalable, and affordable.
Absolutely, that's I think a great way to end this learning lab. Thank you very much, Rob. I very much enjoyed this. I hope you did too, and I hope the audience find the you know, good things to take away from this session. If there's no more questions, well, you can always see this on demand, and we look forward to the next one. Thank you very much, Rob.
Thank you, Mamoun. Thank you, everybody.
Goodbye.
Bye.